Welcome to Stocks in Translation, Yahoo Finance's video podcast that cuts through the market mayhem, the noisy numbers, and the hyperbole to give you the information you need to make the right trade for your portfolio. I'm Blikre, your host, and with me is Yahoo Finance senior reporter Allie Canal, who's here to keep things simple, understandable, and interesting. Today, we're going to be focusing on the U.S. economy ahead of a big Fed decision this week, and that's as the full effect of tariffs still ripples across the world. There are some economic cracks, yes, but critically, do we still avoid recession? Our phrase of the day, strategic resilience. It's how businesses and economies can still thrive amid all these tariffs. And according to our guests, it's about agility versus adaptability. And this episode is brought to you by the number $40 billion. That's how much construction money was just spent on U.S. data centers thanks to AI in June alone. How long can the hyperscaler spending spree on AI infrastructure last? And today, guess what? We are welcoming back Gregory Daco. He is the EY chief economist, where he briefs CEOs and boards on the global economy and the Fed. He's also a judo black belt and competitive triathlete, disciplined, data-driven, and battle-tested on and off the mat. It's great to see you again here.
A pleasure, Jared.
All right, let's just dive into, we're going to get to strategic resilience in a second here, but what do you think about the Fed meeting this week? It's a big one.
It's a huge one. It's one in which the Fed will likely resume its easing cycle, but there's likely to be a few dissents when it comes to the actual vote for the rate cuts. There's likely a small majority that's led by Jerome Powell that is in favor of a 25 basis point easing of the Fed funds rate because there has been some evidence that the labor market is softening, notwithstanding the reacceleration in inflation. But at the same time, on both ends of the spectrum, you're going to see a more hawkish dissent in favor of a hold, likely from a couple of regional Fed presidents. And then you're likely to see a dissent in favor of more easing, 50 basis points or perhaps more, with Governor Bauman and Governor Waller likely dissenting in favor of a larger rate cut, and potentially Stephen Moran also dissenting.
That's amazing because we got three different buckets there, and we're going to tackle all that. First, let's get to our phrase of the day because it kind of captures all of this. Strategic resilience. This is the ability to thrive amid tariffs, fragmentation, and a rewired global order by absorbing shocks, adapting fast, and sustaining growth. And as you said, Greg, when you mentioned this in your notes to us, it's about adaptability versus agility.
Yeah.
So how do you think about this? And this is a very consulting term.
Yes.
But break it down for us.
Well, I think there are two key elements for any business navigating this environment of uncertainty. The first one is being able to be resilient in the face of numerous shocks. We're going to be in an environment going forward where there are going to be a lot of supply shocks to trade, to goods, to labor that are going to affect economic activity. So you need to be able to be resilient in that environment, be agile, be flexible in how you manage your business, be able to use scenario planning as a means to first forecast potential outcomes, but then also be adaptable to those outcomes. The second pillar of that is actually building robustness, being able to withstand these different shocks, having the robustness in terms of capital, in terms of infrastructure, in terms of operational resilience, and really be able to navigate all these shocks that are coming all at once and are likely to be present for the foreseeable future.
Are there any sectors in particular that maybe are able to embrace that strategic resilience better than others, especially within this current environment?
Well, I think we've seen a few sectors actually stand out in terms of their robustness. We've seen the healthcare sector, for instance, continuing to thrive, but we are also seeing some sectors that are gradually adapting to this shifting in economic conditions. The retail sector and the consumer sector in general is having to adapt, not just because we're seeing cyclical headwinds in terms of spending, more sensibility to prices, and a labor market that is softening and therefore weighing on income, but also because people are spending in a different way. They're not just responding to the traditional signals that are being given from the retail sector, and that is requiring some adaptability. And just broadly speaking,
Sure.
We're also seeing businesses adapt to new technological developments. And
AI.
AI is a key one. It's not just a key element in terms of supplying goods and services, it's also a key element in terms of driving demand. And both factors are very important.
I want to bring this back to the Fed and the economy. The Fed has two mandates on the employment front and also the inflation front. And you mentioned the kind of deteriorating job numbers that we've been seeing. Nothing in panic territory yet, but they're moving the wrong direction. One of the things that stood out to me last week was unemployment claims. Those hit a 4-year high, and that's weekly. So we get that on a weekly cadence, and that's what everybody was watching over the pandemic. Is there some number and some threshold in there that leads you to believe, okay, we don't have this job market robustness or resilience anymore?
Well, I think broadly speaking, we are seeing softness in the labor market. The initial claims are indeed a live indicator that is updated every week and gives you a pulse on the economy, but it's also subject to potential volatility. Volatility that's related to holidays or volatility that may be related to developments in certain states like Texas for last week. So we have to take those into consideration as well. What I pay close attention to in terms of those weekly claims is the number of continuing claims. How many people are continuing to file for unemployment benefits? And that's been on a steady uptrend. It's essentially at the highest in over 3 years. So that tells me that there is softness in the labor market. You look at job growth, currently averaging 30,000 jobs on a monthly basis. You look at the year-to-date job cut announcements. They're up 66% relative to last year. You look at hiring intentions from CEOs. They're essentially saying that 1/3 of CEOs are planning to cut their labor force over the course of the next year. And you look at consumers, they're also the most pessimistic about the labor market and labor market prospects that they've been in the post-recession era. So that is essentially telling me that there is a broad-based softness in the labor market.
Now, we still have the unemployment rate fairly low, although we are in this low hire, low fire environment. How long can we sustain that, though? How long until that breaks where, okay, low hire, low fire, we're not seeing mass layoffs, but at a certain point, you'd have to think that the labor force is going to start to weaken even further from there.
It's a very uncomfortable balance right now because you have this environment of low hire, low fire, but that can quickly turn into low hire, more fire. And that is a potential significant headwind in terms of economic activity. And the reason being that the key pillar to the U.S. economy is consumer spending. And consumers rely on income when it comes to their outlays, especially in an environment where inflation is reaccelerating. They need that strength in income to be able to spend. Now, if you have a labor market that is softening, where businesses are not just limiting hiring, but they're also making strategic decisions to right-size their talent pool, then that becomes a further headwind in terms of income growth and then in terms of spending. And what we're hearing, unfortunately, in terms of businesses is that they are being increasingly forceful in terms of their talent pool management. They're proceeding with strategic layoffs for sectors that have a lower return on investment. They're essentially using mandates to return to the office as a means to recalibrate their workforce. They're also using more performance-based layoffs as a means to right-size their talent pool. So all of these factors are coming into play, and it's psychological oftentimes. If there is a series of companies that start firing at a more rapid rate, then that could send a signal to other firms that perhaps they should be doing the same. That's really the uncomfortable balance that we're in.
And what about the signals that we're seeing to consumers? Because one of the things you mentioned, and I just wanted to expand on this if you would, is there are changing behaviors with respect to the consumer. How are these being manifested throughout the economy? And are you seeing, is it that there's a dispersion? Like, is it the wealth gap, the income gap? And then what does it take? Like, what are the warning signs that you would see there in consumer spending?
There's definite polarization when it comes to spending. And we've seen that for the past 18 months. Essentially, higher income individuals, higher income families are still doing relatively well. Lower income families are increasingly struggling because they're facing more pressures from inflation. Inflation when it comes to the cost of housing, when it comes to grocery prices that are surging as a result of the tariffs. These are increasingly pressuring lower end of the income families. But the thing is that in the current environment, it's not just these low income families that are being hurt. It's increasingly medium to upper median income families that are being impacted by the current environment, and they're limiting their spending as well.
Real quick, when is that cliff? Where is the cliff and what's the level?
There's no guarantee that there's a cliff. Let's just be sure about that. We are seeing a slowdown in the labor market. We're not seeing a cliff in the labor market, but under these ongoing pressures, there's a risk that we start seeing negative payroll numbers because we have a shock to demand and we have a shock to supply. Let's not forget immigration restrictions are a key restraint in terms of job growth as well. And those factors could essentially turn to a more pronounced contraction in consumer spending. That's not our baseline case, but as I was just saying, this uncomfortable balance is really what we should monitor very closely, because at one point that could tilt into the negative territory.
And there's an argument I've seen being made on Wall Street about the jobless expansion and how that's tied to stocks at record highs. And part of the reason for that is the labor market's deteriorating and now the Fed is going to cut. I know you're an economist, but I'm curious what your thoughts on that are. The stocks are continue to climb because the Fed is going to cut, but they're not necessarily cutting for good reasons. It feels like at a certain point that's going to break down.
Kind of reminds me of 2007, because the construction boom was called a jobless recovery. Like, these aren't great jobs. And, we had the global financial crisis. Not that we're going to, duplicate that, and sorry to interrupt.
No, but can we have a jobless expansion?
I think it's very possible. I think we're seeing conflicting winds in terms of economic currents affecting the U.S. economy. On the one side, we're seeing essentially a number of policy headwinds that are constraining economic activity. The tariffs, the immigration restrictions are limiting the economic expansion. But at the same time, we're also benefiting from this strong AI wave. You were talking about data centers and construction activity in terms of data centers. That is a key pillar and support to economic activity. But I'll give you another one.
Sure.
The amount of contribution to GDP growth from investment in software in the second quarter, which only represents 4% of the economy, was as large as the contribution from consumer spending on services, which represents half of the economy. Both added 0.6 percentage points to the economy. One is 4% of the economy, the other one is 50% of the economy. That's how big the AI investment boom is right now, and that's providing a very welcome tailwind to the economy and offsetting some of the policy headwinds.
That is perfect, because we're going to dive into that AI data center business right after the break. And guess what? We are going to be back. But coming up, we're going to be talking how AI is fueling record construction build-out and Chop Chop, a martial arts-themed runway showdown. Stay tuned. This episode is brought to you by the number 40 billion. That's how many construction dollars were spent on U.S. data centers alone in June, which is a 30% increase from the prior year. And a fresh record, by the way. That's according to B of A, citing the U.S. Census Bureau. And Greg, these are some really big numbers that we've been talking about. But this has to do with the hyperscalers, Microsoft, Alphabet, Amazon, maybe a few others in there. How long does the party last here, and what happens if the growth just merely slows down a bit, not even reverses?
I think we have to take a broader lens when it comes to this technological revolution. If indeed this is one, it's going to play out over multiple years. If you think back to different technological revolution, the industrial revolution, electricity, the IT and computer age,
Sure.
All of those were over multiple years. And one thing we often forget is that the first step in any technological revolution is investment. You need the infrastructure to be able to support that technological revolution. And only then, when you have the infrastructure, can you build the skills and then get the productivity benefits from that technological revolution. So I think what we're seeing is essentially the first step, a great degree of investment in the infrastructure necessary to support the AI advance. And over time, over the next 2 to 3 years, we're going to see greater benefits in terms of productivity growth, which will likely prop up the economy and support it going forward.
Do you think, given that we're still in the first phase here and there still is a lot more infrastructure that's needed, do you think Wall Street is underestimating some of the productivity gains that we'll see in AI maybe in the short term?
I don't think so necessarily, because my impression of what's happening in equity markets is that there's an underpricing of downside risk to economic activity, notwithstanding the tailwinds that we're seeing from AI and from AI investment, and down the road from greater productivity growth.
So too much exuberance right now.
I think there is a little bit too much exuberance relative to the downside risk to the economy. And that's what we're seeing reflected in the bond market. The bond market is much more nuanced when it comes to the economic outlook. It's pricing in higher inflation, a higher debt trajectory, more risks of influence on the Fed when it comes to guiding monetary policy. I think those are the right way to essentially construct a view around all the risks, upside and downside risks to the U.S. economy.
And we do have yields lower now. The 10-year is right around 4%. The 30-year has come down. What signals can you watch for in the bond market to maybe paint a better picture of potentially what's to come down the line?
Well, I think if we think about the different drivers of long-term growth, it's all around the supply side of the U.S. economy. And right now we're seeing a lot of shocks, negative shocks to the supply side of the U.S. economy. But productivity growth is a key pillar to economic activity. It's the holy grail in economics because it supports supply side dynamics, it supports a greater economy with greater potential, but also it helps alleviate inflationary pressures.
That was kind of like the late
exactly
90s
what you
story,
want.
right?
Exactly. When you have this combination of an economy that's growing at a fast pace and inflation that's not a threat, then the Fed does not need to raise rates. And then you can have a bond market that is not reflective of these potential risks to the economy, where yields are actually lower, and that supports greater investment and greater capital activity.
So let's game that out a little bit because I'm fascinated by this. Any specific signals that you could point us to in the bond market that might indicate whether productivity is on the rise? Is it just the fact? Would it just be that the record fiscal expansion of the United States doesn't seem to weigh on bond prices, and you don't see those yields blow out the way they have been at certain times? Like, what are the signals that you get from the bond market?
Well, I think the bond market in general is uncertain about the trajectory of the U.S. economy. It's kind of on the verge in this uncomfortable balance when it comes to the economic outlook. It's seeing higher inflation. It's seeing the headwinds in terms of economic activity from tariffs, from reduced immigration. But at the same time, it's also acknowledging this boost from stronger productivity growth. And let's not forget, 2023 and 2024 were years of exceptional productivity growth that was pro-cyclical. We were seeing strong productivity growth at the same time as we were seeing an economy growing at 3%.
Recession. It was a big deal.
Slowdown in inflation and no recession. The recession that was called back in 2023 never materialized. So we were in a very strong environment. So that tells us that essentially the ramp in terms of AI further lifting up that productivity trend is actually quite solid, quite robust. And so I'm quite encouraged by the prospects of stronger productivity growth over the next few years, lifting the U.S. economy's potential and therefore limiting inflationary pressures. That notwithstanding, I still feel like over the next 18 months, we're going to be in a stagflationary light environment with lower growth and higher inflation. Yes.
Yeah. How do you define that stagflationary light?
So people misunderstand stagflation. Stagflation is high inflation. I'm not talking about 2.5%. I'm talking about 5-6% inflation and stagnation in economic terms, which is essentially 0% growth or lower. Right now, the economy is growing at about a 1.5 to 2% clip. So we're not in stagflation territory. But stagflationary light is essentially an environment where inflation is accelerating and growth is moving in the opposing direction. It's slowing. That is the type of environment we're going to be in, which is quite uncomfortable for businesses and for consumers because they're seeing prices rise, costs rise, and they're seeing demand and potential volume growth being put under pressure. That's really uncomfortable for anyone.
All right, one more question before we get to the runaway showdown. You were saying before how we are just in the early innings here. What is the next inning? So we don't have necessarily that hyperscaler, massive CapEx investment anymore. Is that when we see the productivity gains? Like what lifts things in that next boom phase?
There's one more step between the capital investment and the productivity growth. It's the talent. You need to have the talent to be able to manage any type of technological revolution. So it's having the right people with the right skills.
Sounds like you need a consultant.
You do. But it is very important to be able to understand the technology, have it in place, have the software in place, have the infrastructure in place, have the data centers, the cybersecurity, everything in place, but also have the talent to be able to use that technology. It's not just about a few queries on a large language model. It's really about how do you integrate AI into your holistic corporate strategy, and how do you build that strategic resilience that we were talking about earlier with that technology in hand?
And real quickly, I imagine that talent is difficult to find considering we are in the early innings here. So how do you scale quickly? And does this start with those younger workers or maybe folks in college really trying to rethink the path forward?
It's a paradox, right? Because we're seeing actually upward pressure on the unemployment rate for the younger generation, but that may actually be the generation that is most apt at navigating this technological revolution because they have the innate skills to manage that. So perhaps businesses and corporations to rethink their talent needs as a function of this technological revolution that's taking place, and not just think we're going to substitute labor for technology, but really think about how you can complement technology with the right skills.
That was a really interesting point there. We do need to get to today's Run Day Showdown, and I believe I'd mentioned before that Greg here is a practicing black belt in the martial arts known as judo. And on today's Showdown, we've got something like a judo match for the economy. We are pitting the steady stance against the quick pivot. First, the steady stance, feet planted on the mat, good balance, a firm grip on cash and costs. That's how companies absorb shocks when policy changes or prices inch higher. Then, the quick pivot. Light on your feet, ready to change angles, rework suppliers, and deploy AI where it counts. In martial arts, footwork often decides the fight, and in business, it decides who adapts first. Both approaches can win, control the opponent's momentum, or use it. So which style, Greg, fits today's slower growth and stickier inflation? The steady stance or the quick pivot?
I think from a judo background, you have to have both. You have to first measure what type of forces are influencing the economy, and then you have to use that momentum in your advantage. There are major pivots that are happening, both in terms of the domestic economy, but also in terms of the global landscape, increasingly fragmented. So you really have to have both. You have to have the ability to be agile and pivot rapidly, but you also have to have the robustness to be able to withstand the opponent's forces and any headwinds that come your way. So from a firm strategy perspective, you really have to have both the agility and the adaptability.
All right. That is actually time here, and really appreciate you stopping by once again, Greg. Learned a number of things, and we got to the hyperscalers, but first we were talking about strategic resilience and how in consulting terms that means you just got to be able to adapt with the times. And I found it interesting how really early we are in this whole AI saga, and kind of reminds me of the Gartman hype curve. But that's a term for another day there. But when it comes to AI, I think it was important to focus on the fact that the demographic that is getting marginalized right now by the job market is probably the most likely to be critical when it comes to needing to implement all this AI knowledge and figuring it all out on the other side. So having said that, we are winding things down here at Stocks in Translation, but make sure to check out all our other episodes of the video podcast on the Yahoo Finance site and mobile app. We're also on all your favorite podcast platforms. So be sure to like, leave a comment, and subscribe wherever you get your podcasts, and we will see you next time on Stocks in Translation.